Everybody talks about rental return and growing a portfolio here in Dubai. But what if I told you that the real play is capital appreciation and making sure that you purchase the right property at the right time and catching that capital appreciation here in Dubai real estate? And exactly where I'd put my money today for the highest capital gains. Since working in Dubai real estate, I've specialized in Arabian Ranches 3, where we're sat here today. It's a fairly new area. The handovers only started 2 years ago, and there is still 3 more years of construction to complete before this whole community is fully developed. Over the last 2 years, there's been 4 major clusters handed over here in Arabian Ranches 3. That includes Sun, Joy, Spring, all 3 and 4 bedroom townhouses with the same size units. And the likes of Ruba, slightly larger sizes, larger plot, the more preferred type, hence why there's a price difference between Sunjoy Spring and Ruba in itself. All of these clusters consist of 3 and 4 bedroom townhouses, 3 beds in the middle and 4 beds on the end of each row. The next cluster to hand over is Bliss. Now, Bliss is the latest project in Arabian Ranches 3 to complete. Only 30% of Bliss is complete, and investors are making massive capital appreciation in this cluster because the sizes are even bigger than Ruba. If capital appreciation is your goal, then this video is going to save you a lot of time and a lot of money from investing in the correct project or just knowing how to spot the correct investments. Because just one wrong investment in the real estate market can ruin your financial model completely. But not only that, it's probably going to put you off investing again. Now, before we discuss the investment framework on pure capital appreciation, it's important to understand that Dubai has got 2 markets. One purely for rental return and one purely for capital appreciation. You have to pick the right area for whatever your goal is, because let's be honest, you can't have both. You're never going to get the highest capital appreciation in an area that's fully matured, nor are you going to get the highest rental income in an area that's brand new, not matured, and people don't know about it yet. Let's look at a couple of examples. You can look at downtown Dubai. Most of the plots in downtown Dubai are completely sold out. What's there is there. The infrastructure is there. The Dubai Mall's there. The Burj Khalifa is there. You pretty much got everything you need in downtown Dubai. So you want to buy in downtown? Let's say you're buying a ready property, already complete. It's been there for 10 years. It might be good for a renovation project if you're into that, or it might be great for rental returns. You can put it on a short-term let and rent it out straight away. However, you're not going to see massive margins like other areas over the next 2 to 3 years. Now, if you actually want to double your money, you need to be looking in areas like Arabian Ranches 3, the Valley, MR South, and Expo City. These 4 areas are hotspots for investing here in the UAE over the next 5 years. You're probably thinking, why is this the case? If you look at Dubai Masterplan as a whole, there is only so much space. Majority of Dubai is already complete with plots, communities, Dubai Hills, downtown Dubai, Medina, Jumeirah Golf Estates, all these areas that are already residential, price per square foot of 2,500 upwards. If you're looking at areas with a lower price per square foot, you need to be looking at these areas because there's only so much space for the amount of new residents coming into Dubai every year. Every single year, there is around 150,000 to 200,000 new residents here in the UAE, meaning that there's not enough supply for the amount of demand, especially in the townhouse and villa communities. The reason why these areas are such good hotspots to invest in over the next few years is because there's people already living there. Like, we're in Arabian Ranches 3 now. You look around, the community center's full, people are using the pool, people are living here, 90% occupied, whether that's owner occupied or whether that's rental. So if you're an investor, it's a hotspot. You know what the price per square foot of the ready units are, and you can just look at what you're buying at and compare it to the ready units. Hypothetically, let's look at an example. If you want to buy a project that's 12 months away from completion and the price per square foot is only 1,500 dirhams per square foot, but you can look at the area that is ready now in the same community that you're buying into, and you can look at that and say that's 1,800 dirhams per square foot, you're already winning. You know you're in for at least 300 dirhams per square foot without the market even increasing. So when more amenities come, like a school, like a souk, like a park, you're going to expect the prices to increase, even here in the ready units, meaning that it'll go from 1,800 to 2,000 per square foot by the time you get your handover. So if you were to ask me where I'd invest my money, then I'm going where the growth is. Now, you see it a lot, investors getting burned, people selling below OP, at OP. These investors who can't afford to make the payments because they've been either over leveraged or the market's not increased. And the reason is they've either picked the wrong area or they've bought in at the wrong entry point. It's important to understand both. Unfortunately, The saddest thing about this is within that same time frame that they had invested in this project, they could have made money if they picked the right area. However, they didn't, and they're sat on an asset that's not increased in value, and potentially they've lost value, meaning that they've also lost liquidity, and worst case, they can't exit. So how do you avoid that? Well, here's my 5-step framework, the exact checklist I run through before recommending any project to my investors. Number 1, buy into developing master plans. What do I mean by that? Communities that are growing, that are not complete. You look at a master plan, you can see 10% complete, that's a developing master plan. Number 2, focus on the price gaps. Look at how much the ready stock is transacting for on a price per square foot basis. Compare that to what you're buying in at off plan. If you know you're buying in much cheaper than what the ready stock is transacting at on a price per square foot basis, then you know you're safe. As the community matures, the price gaps will shrink, of course. Not only are you going to make appreciation, that's why it's so important to time the market and make sure you're entering at the right point. Number 3, future supply check versus growing demand. So let's look at how many projects are completing over the next 3 years. And you compare that to how many residents are moving into Dubai. Great thing about Dubai is we live in an engineered economy, and I've mentioned this before in a previous video, where Dubai government is actually planning in advance exactly how many units they need to hand over in order to control the supply and manage the amount of demand for them units. Therefore, it's important to understand, is there a lack in townhouses? Is there a lack in standalone villas? Or is there a lack in apartments? And where are you going to invest? And what products are you going to invest in out of them 3 to ensure that you can make maximum return on your investment? It's also super important to know how the developer controls supply on handover of these units. Now, each developer works in a different way. Some developers will hand over units quicker. Some developers will delay handovers. Everybody's got their opinion about developers, right? But knowing the procedure on how these developers work before you buy into the property is such an underrated metric, because if the developer oversupplies the market on handover, you're going to throw away your liquidity because it's not easily exitable on the handover anyway. Maybe in a couple of years once everything else is sold off. However, buying a development that you know will stagger the handovers, they'll delay the handovers, as annoying as it might be for some people who want to live in it, for the investors, it's great because there will never be an oversupply and there'll always be a steady flow of demand. The 4th is understanding infrastructure timelines and major community anchors. Actually looking at where the RTA investing their money. The RTA have recently announced billions of dirhams worth of investment into the roads. And if you're not looking into these metrics, then how the hell are you going to know where to invest? These new roads are going to connect Dubai communities in a much more efficient way, especially these new communities where people think it's too far. Before you know it, Arabian Rancher Street is going to be within 10 minutes of Dubai Hills. And people don't even look at these metrics. Just keeping up with the general news is one of the most important aspects of investing in Dubai. And the 5th one is planning your exit time. Now, everybody's got different time frame, but the important thing is you don't hold it forever, because you're not an owner who's planning to rent, you're an owner who's looking for appreciation, and you want to recycle your cash, which means that if you sell it just before the handover, you can take your maximum return on equity, regardless if the other owners continue to make 5-10% more. It doesn't matter, because you're going to recycle the cash into the next project before they sell theirs and they buy into the next project. Because bear in mind, everything is relative. I'll give you a case study. If you look at handovers in Bliss at the moment, and people are selling 3 bedrooms at 3.3 million, hypothetically, they're deploying their cash straight into Bliss Phase 2, same layout, same product, they already know it works, it's pretty much a guaranteed return. They're buying in a 3-bed at 2.8. Handovers in 12 months, less than 12 months actually. But what happens when all the other owners wait a little bit longer to squeeze the amount that they can get out of Bliss 1, sell it for maybe 3.4, 3.5, then they all run to Bliss Phase 2. By that time, Bliss Phase 2's already reached 3 million. So it's all relative. Even though you might sell on the handover, you might be the first owner to sell, you'll be the first owner to reinvest into the next phase. Now, this is my personal framework that I use every time I analyze an investment before I present it to my client, ensuring that it meets the client's needs, goals, and most importantly, we make a massive capital appreciation. So Based on the framework that we've just discussed, here are the top 3 areas for capital appreciation in 2025 that I'm personally advising my clients on investing right now. Firstly, of course, Arabian Ranches 3. You're still early and prices still have room up to 50% appreciation easily. There's already proof of concept, people are already living here, and you've got Arabian Ranches 1 and Arabian Ranches 2, both at a much higher price per square foot than Arabian Ranches 3 is today. Second is Expo City. Now, why is Expo City such a good investment in 2025? Well, firstly, you've got the World Trade Center. The World Trade Center is going to hold over 600 events annually, bringing in over 3 million tourists every single year. On top of that, all the major companies are moving their headquarters to Expo City. Thirdly, the Valley by Emaar. At the moment, the Valley is slightly further away from any other project here in Dubai, meaning a very attractive price per square foot and amazing connectivity to downtown Dubai within 25 minutes and Emaar South also within 25 minutes. So regardless of your budget, there's something for everyone. You can go and buy a 1-bedroom apartment, or you could buy a 5-6 bedroom standalone villa, all of which have massive potential for capital appreciation. So let's have a quick recap. Key points of what we discussed today. Firstly, only buy in an area where you know you're buying at a lower price per square foot on the off-plan market compared to the ready market. Example, 2,000 dirhams per square foot for a ready unit compared to 1,500 dirhams per square foot for the off-plan unit that I'll hand over in the next 24 months. Secondly, don't expect to make quick returns within 3 months. It's not feasible. Wait for the infrastructure to come, wait for the amenities to come, the core anchors of the communities that are going to drive demand, drive mortgage buyers, and wait until the handover of the project if you want to make the maximum appreciation. And thirdly, just keeping up with general news of Dubai, looking at where the RTA are investing the money, look at where the government's investing the money, look at how many residents are coming into Dubai versus how much supply is there. These metrics are so important because too many people focus on one community and the key metrics within the community. You need to look at the wider view, keeping up to date with the government news, the master plan of Dubai, and where the Dubai market is heading. And there you have it. That is the 2025 Dubai Capital Appreciation Playbook. Now, if you're looking to make serious capital appreciation in the Dubai real estate market, I've got access to some of the most exclusive stock in the market. Options that are going to give you low entry prices, massive upside potential, and even flipping without you having to pay the full price, leveraging the best payment plans in the market. So if you want to get started in investing in Dubai real estate, drop me a WhatsApp in the first link in the description below and let's jump on a call. That's all for today. And as promised, capital appreciation explained.